I will be presenting the company overview. Ajinomoto Malaysia Berhad, established in 1961, is a leading food manufacturer in Malaysia, specializing in producing and distributing monosodium glutamate or MSG, seasonings, sauce, and frozen ready meals. With a focus on quality control, the company adheres to halal certification and ISO standard. Ajinomoto serves household, food manufacturers, and the food service sector across Malaysia and export to Southeast Asian market. The company's brand philosophy is eat well, live well. To remain competitive, Ajinomoto has expanded its product line, embraced digital marketing, and implemented sustainability initiatives. The company has been recognized by Jabatan Kemajuan Islam Malaysia for its excellence in halal certification. Ajinomoto Malaysia also support the Ajinomoto Group's global goal of contributing to the well-being of all people, communities, and the planet. The company aims to address environmental issues and nutritional challenges in line with the United Nations Sustainable Development Goals.
Alright, thank you to the previous presenter, Sister Hannah, for the insightful explanation. So before I start, let me introduce myself first. My name is Ko Alia Kristina binti Kumazan with the batch number 2318858. Right, so now I will present the analysis of the company profitability performance over the 5-year period from 2020 to 2024. Overall, it's highlighted the trend show earlier fluctuation followed by strong improvement in recent year. ROE and ROA dropped in 2021 but recovered back significantly by 2023. ROE then peaked at 0.52, then slightly decreased to 0.43 in 2024, while ROA remains stable at 0.36, indicating consistent asset efficiency. Next, for the GPM, gross profit margin, was higher in 2021 at 0.48, but gradually declined to 0.35 in 2023. Likely due to the rising production costs. However, it slightly recovered to 0.38 in 2024. And next is the most notable improvement was in operating and net profit margin. Both ratio declined up to 2022 but saw a sharp increase in 2024. Operating margin rose to 0.71 and net profit margin to 0.53, indicating strong cost control and profit growth. In conclusion, what I can conclude, despite earlier setback, the company shows significant recovery and improvement profitability by 2024, reflecting strong financial and operational strategy. Thank you. That's it from me. I will pass to the next presenter.
Okay, now we're going to liquidity ratio. As you can see, this shows the table for the liquidity for the current ratio and quick ratio for Ajinomoto. From this base, we can see that the current ratio from 2020, which we get 5.49 million, it shows that the strong liquidity position with high current asset. And from 2021 to 2023, as you can see, it declined. It dropped to 1.77, indicating rising pressure to meet a short-term obligation. And the last one in 2024, 5.28 million. It showed that it have a sharp recovery, suggests improved cash flow and reduced short-term debt. Now we go to the quick ratio at 2020, which is 4.74. It showed that a strong ability to pay off short-term debt without inventory. While for 2021 to 2023, it showed a decline to 1.27 million, showing a weaker immediate liquidity. And the last one for the last year, which is 2024, which is 4.54, it showed a significant improvement, reflecting a better working capital and cash control.
Next, I'm Azura with a magic number of 211296 and I'll continue with activity ratio. As for the inventory turnover of Ajinomotos, the result shows a decrease from 2020 to 2022 and then an increase in 2023, then a drop in 2024. This result can be seen as the Ajinomoto's inventory was moving slowly from 2020 to 2022 and maybe because of the weak sales or overstocking. And then in 2023, when the result shows an increase, this can be because there is an improvement in the efficiency of inventory management by the Ajinomotos. But when the 2024 shows a decreased result, this can be because of the slowdown or inventory build up from them. And then as for the account receivable turnover, the result shows an increase from 2020 to 2022 and just a slightly drop in 2023 and then back to increase in 2024. The overall result can be interpreted that the Ajinomoto company have the efficiency in collecting the money from its customer, and the result shows that there is an improvement from year to year. This can be because they have better credit policy or because of the stronger collection effort that made their customer pay faster over time. And then this also in line with the average collection period of the Ajinomotos, where the result shows a decrease from 2020 to 2022 and then a slight increase in 2023, then slight drop in 2024. The result really shows that the customer of Ajinomotos are paying faster over time and the company is having a healthy cash flow from its receivables. However, the company may have problem with their payables because the account payable turnover shows a result of decrease from 2020 to 2022 and a sharply rose in 2023 and back to a drop result of 2024. Same with the average payable period, the result shows an increase from 2020 to 2022 and then a drop in 2023 with a significant drop but then back to an increase in 2024. This can be interpreted that the company have a problem in paying its suppliers. They always have the delay in their payment and this can result to affecting the relationship that they have with the suppliers. They only improve in 2023 but still in 2024 it shows some delay again. And lastly, when the total asset turnover shows a decrease from 2020 to 2022 and only increased to 0.81 in 2023 and back to drop in 2024, this result overall shows that asset efficiency to generate sales is inconsistent and they generate fewer sales, especially in 2024, maybe possibly due to underutilization or overinvestment in their assets.
Now we go to market ratio. We start with earning per share. In 2020, the earning per share is 0.98. It shows a strong profitability per share. Now we go to 2021, it dropped to 0.76, and also in 2022, it dropped lower than 2021, which is 0.28. This show a reflect declining profit. However, in 2023, it improved to 0.45 and surged to 6.60 in 2024. This signaled a strong turnaround due to the higher net income or better cost control. Now we go to the price earning ratio. In 2020, the price earning ratio was 13.27. It showed a reasonable valuation and then rose to 20.89 in 2021 and peaked at 51.79 at 2022. This showed a stock possibility overvalued as an earning decline, and then fall to 35.51 in 2023 and sharply to 2.82 in 2024. This showed a drop due to a strong earned recovery, making the stock appear undervalued. That's for market ratio. For market to book ratio, it is relatively stable within 2020 to 2023, which is 2020 is 1.60, 2021 1.88, 2022 is 1.74, and 2023 is 1.84. But however, in 2024, it dropped to 1.22 which is suggests the market price didn't rise in line with the company improved book value, this possibly showing a market under reaction.
Assalamualaikum warahmatullahi wabarakatuh. My name is Naysa binti Osman and I will present the financial ratio and the Dupont ratio analysis. So, for financial ratio, I will start with debt ratio. So, for debt ratio, as you can see in the table, the result in 2020 and 2024 are particularly low. This means that the company less reliant on debt. For instance, in 2024, the 50% of the firm's assets are financed through debt. So in debt equity ratio, same goes to debt ratio. In 2020 and 2024, the ratio are low. So it means that the company are relying on equity rather than debt. Compared to the other years, the company rely more on debt. So for next for TIE ratio, time interest earning ratio, in 2022, the result shows the highest, as it means that the company could cover the interest expense 469 times, which is shows that the company is strongly profitable. Next, for the point ratio analysis, I will highlight on the lowest and the highest. So for the lowest in 2022, it shows that the 3% ROE, which is the lowest compared to the other years, it is due to the lower profit margin compared to other years. And in 2024, it shows 43% of ROE, which is a lot higher compared to the other years, which it is due to the higher profit margin. So if the company could maintain its profit margin, it could the overall ROE could remain strong.
Now we go for the weakness and recommendation. We start with the first weakness. It is instantly profitable in 2020-2023. From 2020 to 2023, Ajinomoto profitability declined sharply. In ROE and ROA dropped to 0.03 and 0.02, while the operating margin fell from 17% to just 2%, which indicating a rising operational cost and weak cost control. So to avoid this weakness, I have a recommendation. So the first recommendation is cost optimization. So Ajinomoto should adapt lean management, review its cost structure, negotiate a better supply term, minimize waste, and automate a production to improve the margin. So the second recommendation for me for this weakness is the diversified revenue stream. This expanding into a new product or market can stabilize revenue and reduce dependence on a narrow product range. So the third recommendation for me is a strategic pricing and innovation. This implementing a value based on pricing and ongoing product innovation can boost a customer loyalty and strengthen the pricing power. So in Islamic perspective for this is from a Sharia point of view, ihsan, which is excellent in business operating, is encouraged efficiently, fair pricing and avoiding israf, which is extravagance and wastefulness. Aligned with Islamic business ethic, ensuring fair return while maintaining accountability to a shareholder, employees, and the broader community is also seen as a trust, which is amanah. Now we start with the second weakness and recommendation. So the weakness is declining liquidity. So Ajinomoto experienced a significant drop in liquidity, with the current ratio falling from 5.49 to 1.77 from 2020 to 2023, and the quick ratio from 4.74 to 1.27. So this suggests a tighter working capital and a potential cash flow of mismanagement. So my recommendation for this weakness, I start with a better working capital management. This can tighten the monitoring of receivable, payable, and inventory cycle can improve liquidity, establishing a clear credit policies and shortening a receivable collection period may be beneficial. So the second is cash reserve strategies. Maintaining a buffer of a cash or higher liquid instrument help weather short-term financial stress. So my third recommendation is inventory management systems. Implementing just-in-time, which is GIT, inventory or advanced demand forecasting may help a balanced stock and cash efficiency. So the Islamic perspective is Islamic emphasize al-wasatiyah, which is moderation in financial practice. Excessive debt or dependence on external liquidity could lead to a financial injustice, which is zulm in Arab, and against the stockholder. So in Islam, encourage maintaining liquidity to meet obligation timely, aligning with the principle of fulfilling contract and trust. We go for the third weakness and recommendation. We start with the weakness. So the weakness is its weakened asset and inventory efficiency. Ajinomoto asset and inventory management efficiency decline, with the inventory turnover dropping from 4.50 to 3.38. This indicating a slower stock movement. The total asset turnover fell into 0.58 in 2024. This reflecting reduced revenue generation per asset invested. So the recommendation for this weakness is we start with an asset utilization review. Underperforming or underutilized the asset should be either optimized or disposed of to ensure higher return and on investment. So the second recommendation is digital integration, where it is adopting ERP, which is enterprise resource planning system, to track a real-time inventory and asset usage can significantly improve operational efficiency. So my third recommendation is continuous process improvement. This incorporating continuous improvement method can increase productivity and streamline the operation. So for the Islamic perspective is in Islam, which is amana in Arab and English it is trust, applies to the use of the resource, whether natural, human or financial wasteful accumulation or mismanagement of inventory contradict the principle of responsibility stewardship, which is Khalifa. A company is morally and socially obligated to optimize its resource efficiency. Now, for the last weakness and recommendation, we start with the weakness, which is volatile market ratio. Ajinomoto market ratio showed an instability with the EPS falling from 0.98 at 2020 to 0.28 at 2022, while the PE ratio surged to 51.79, which indicating an overvaluation and declining investor confidence. Despite a sharp EPS rebound in 2024, past volatility may continue to affect the investor sentiment. So this weakness, there is a recommendation. So the first recommendation is strengthen the investor relation. The transparent communication and regular financial disclosure can help rebuild trust. Second one is stable dividend policies, which is offering a predictable Sharia compliant dividend distribution could attract the ethical investor and enhance the confidence. So the third one is valuation alignment. The company should aim for a realistic valuation based on the fundamental performance, reducing speculative bubbles. So in the Islamic perspective, Sharia view on market stability, Islam finance discourage gharar, which is excessive uncertainty, and maisir, which is speculation, both of which can stem from a volatile market behavior. Businesses are expected to uphold a transparency and avoid a misleading practice, ensuring a fair valuation based on intrinsic worth reflect the principle of adl, which is justice in Islamic ethic. So that's all.